Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. It's Don Juan here. I'm just kidding. Got a bit of a mo going just for something different. Benjamin here, going to talk to you about a very, very, very important theme and how I am starting to play this theme. Now, if you recognize the stock symbol, you may recognize the theme and that I've been talking about it for a few years without pulling the trigger. Well, I believe the time is now. So let's get straight into it. It's a portfolio holding in the publicly available portfolio that you can check out with a link in the description. But before we get into it, obviously, guys, housekeeping. Nothing I say in this publication or anywhere is intended to be, nor does it constitute investment advice. It's my opinion. It's what I'm doing. I share with you what I do. Think of it like a diary, okay? That's all I'm doing, documenting my thoughts, and then I can go back and I can see where I went right, where I went wrong. You guys are along for the journey if you find it interesting, but please, you're responsible for your own decisions and any resulting outcomes that may result. So, with that being said, there's a publication that I'm really, really excited about. It's called The Maverick Life. It's my project moving a long way from home and as of next year, and it will be a project where I take a middle-class amount of savings, okay, and then I try and convert that using various things to generate an upper-class level of income or income level to the 1%. So I show you every trade I make, everything I'm doing. We're currently returning 4.9% on a monthly basis. So if you want to check that out, you can check it out for a free trial in the description also. Alrighty, enough of that. DHT Holdings, it's actually 9:16 as it finished. I had to get this out a little bit earlier. But the point is, here's a one-page overview of the company. All I want to draw your attention to are a few things. I think this dividend yield here will be moving into double digits, given the company has a return policy of 100% of their net income. Net debt to EBITDA looks great. No issues there. Finally, this sector is delevered right at the time where there aren't many vessels available on the water. We're going to talk about that. And the tanker rates are set to skyrocket. Having said that, this company's done a decent job in terms of their return on equity and return on invested capital over the last 12 months. You can see that over to the right here, double digits for both of those. It's fairly reasonably priced on a valuation basis. We've got, over a 12.5% free cash flow yield using that next 12-month market cap, the free cash flow. I think that's extremely conservative. And when we talk about the valuation of the assets this company holds, I'm going to talk about something that I've alluded to before, but we can go right into it and work out how what's accounted for and given as book value, if you just simply look at a screen or a balance sheet, might not give you all the necessary information. So DHT, who are they? They run tankers, okay? They're a pure play on very large crude carriers. There are many different types of tankers. This is the only type of vessel this particular company runs, and it's the type of vessel that and the LR1s that go through the Panama Canal, the Panamaxes. I'm also keen on them, but we'll leave that for another day. 23 to 26, depending on what date you're reading this, okay? It's got a combination of market exposure and fixed income contracts. So part of their fleet, a very small part, has chartered contracts, and the majority of their fleet, as you'll see in a moment, is unhedged. It's open to the spot price. So if you've got a particular opinion as to what might happen in the spot price, it could be very, very interesting over this coming quarter to second half of the year. Counter-cyclical philosophy with respects to investment, employment of their fleet, and capital allocation. I must agree with management. The difference between this type of management and the Greek management is that these guys are actual managers and they care about their shareholders, whereas the Greeks do not. Anyway, we won't go into that saga again. So let's take a look. One thing that you will have listened to with my conversations with Josh Young, we've spoken about that. We've got a couple of our conversations have been recorded. Here, one thing he always asks is, okay, well, how much would it take to build this company from scratch? That's what I want to delve into here. So what do we need to know? We need to know today what it would cost to build one of these things, one of these VLCCs. And I have it understood, it's my little work up here. 120 to 130 million, and then maybe another 10 to 15 million per unit if you need to get the dual fuel capability options, which the way the environmental legislation is being structured, one would suggest that you will have to have, you'll simply have to comply with whatever they say your fuel capabilities will be, and the scrubbers and all that sort of thing, how much sulfur is in your exhaust fumes and so on and so forth. So let's just say 120, 130 is what I've used here, I think. So 26 vessels in their fleet at 130 million. If they lose a vessel, add a vessel, obviously just change its number. Okay. So if you're looking and saying, oh, well, today, in a year's time, you look at this video and say, oh, well, actually, they've got 30. Well, obviously, you'd adjust things. Okay. But 26 vessels new at 130 million cost to build them new, you're looking at roughly 3.38 billion. Okay. Divided by the current shares on issue, plus any dilution that may be occurring, you'll be looking at roughly a vessel replacement value of $20.81. Okay. So if you look here on the balance sheet, you've got 1.2 billion divided by 26, you're looking, call it 48 million per vessel has been accounted for. And why is that? Because over time, the vessels age, and there's a certain schedule, a depreciation schedule that you have to keep in your accounting. And so these vessels will now be marked at that new value over time. The idea is that it represents fair wear and tear on the assets. But the point as investors is we're coming in and we're saying, okay, but gee, the biggest threat to a company like this is that there are a heap of new tankers built, in a 12, 18, 24-month period, and there's all this oversupply of tankers on the market, the day rates drop, and then that's the big threat to this company. Replacement value, I'm going to say, is a rough number of $20.81. Okay. Other things to consider, if you historically, these companies have been jacked up to the gills. During the good times, they just go to the bank, they get all these revolvers, they get all these loans, they dilute shareholders, they do whatever, and they just build more ships, and then there are more ships, and then the tanker rates go through the floor, and then there's crash, and the whole thing starts all over again. Anyway, they've got 130 million in cash. They've got a revolver of 228 that's available. Okay, so, and they have really no debt. Okay, so liquidity is not an issue for this particular company. Depending on how you want to look at it, their debt to their assets is marked at 18%, and that'll be using the accounted value of the assets. Or if you look at net debt per vessel, 11.2 million. And if we're looking at even the accounted value, the depreciated value of these vessels, they could sell off a couple of vessels and they'd be able to pay down a hell of a lot of that debt. Okay. And having said that, really, I don't see any reason why they would need to do that, because the company's been, their balance sheet has been managed very well. So here's the big deal. I wanted to share some other data that I used from Marhelm, but I wasn't sure if that was part of a paid post, and so I don't want to share paid content because I don't want to be that guy. But if you get out and you have a look at what the fleet is doing, it looks really, really, well, bad from a construction perspective, but really, really good from an investment perspective, because when you look out into the future, look at that sort of aqua number there. There is basically bugger off new vessels being constructed all the way out to 2027. So the CEO has made some comments here. If you look, there's an order book out there of 17 VLCCs, 6 coming in apparently at the end of this year. But if you look at the 91 ships that are turning 20 years old as of up to 2025, I'm sure they'll get exemptions, but these ships will eventually have to be retired, and that is a lot more than the 17 that are due to come into the market. So as far as I can tell, there's really been a supply squeeze, and we're about to really feel that. If the order book is at 1.9% of the entire fleet, that's one thing. But if it's at 1.9%, and then you've got all these vessels that will either need to be upgraded, they'll need to have a lot of maintenance done to them, presumably, so they're up to standard to get another, 5 years out of their lifespan. it's going to start to look very, very tight once there are no more vessels available and the current fleet gets saturated. The rates are set to skyrocket, potentially. Here's some comments from the CEO. He seems like a cool CEO in terms of how he's pretty straight down the line. Anyway, I'm just going to quickly skim through here. We know that you count ships, which is what the market is a function of. So please excuse us from maybe stating the obvious, but this picture is quite remarkable and still deserves some airtime. So as we saw on the previous slide, book for new VLCC stands at 1.9% of the sailing fleets. Insignificant would be an understatement. This level of contracted new supply becomes even more insignificant when compared to 30% of the current fleet being older than 15 years of age and 14% being older than 20 years of age. To make this fleet development picture even more compelling from a ship owner's point of view, there are some 90 ships that will turn 20 years of age up to the end of 2025. And then he wrapped it up by saying, by paraphrasing Churchill, keep calm and buy tanker stocks. It was a good way to wrap up the call. And it's kind of hard to disagree with him, really. So let's do a back of the envelope valuation. Current price, or the price at time of me writing this was $9.57. If you go through and look at the analyst expectations of the EBITDA, and I'll explain why I think they could be a little conservative. Here's what you get per share. So earnings and EBITDA per share. Apply a multiple. Yes, I'm using a reasonably high multiple for this valuation. If you don't like it, simply put in your own. The reason I'm doing it is because of the factors that I mentioned with the fleet becoming extremely tight. I don't think it's going to be easy for you to buy a company with all their vessels at a cheap valuation. It just doesn't make sense. Anyway. So if you look at that, an equally weighted average of $13.40, and if you remember the replacement cost, I estimated somewhere around $20.81. Either way, in this lower case here of $13.40, you could be looking at an upside of 40% in share price appreciation by the end of 2023. And if you're willing to hold out for longer in 2024, it could be a lot more than that also. This is a list of the fleet, and here all I wanted to point out was there are only 1, 2, 3, 4, 5 under contract. Those contracts are rolling off at the end of 2023, end of 2024, and then a few longer dated ones. The rest are all being contracted via the spot rate. Okay, so the daily on the spot rates for these types of tankers. If we start to see the market get very, very tight, well, these spot rates are going to really shoot up. And this is where we can get that torque or that upside leverage to the day rates, similar to what I've been speaking about with the offshore drill rigs for Transocean, so on and so forth. The difference is this company is already making money at a much lower rate, trading at a steep discount, and it doesn't have the balance sheet issues that, say, a Transocean might. So if I go through from the quarterly report, the average spot rate was 46,000. Okay. The break even for this company has been calculated at 26.7. So obviously they're doing very well, even in the current environment. If you were to, I was just playing around here, and if you were to look at the 5-year average, and if we were to get a squeeze around this end of the year, where the 5-year average is around 80,000 a day, what would that do to its EBITDA? Okay. So its EBITDA would come up to what its revenue was last quarter. Okay, so they would get a significant jump. If you assume the company keeps it roughly the same EBITDA margin, you're getting 3x the EBITDA that the analyst has assigned. In other words, what I showed in the back of the envelope might only be a third of what the company actually makes. Now, obviously, that's subject to outside circumstances, so you can't bank on it, but it does give it a real X factor coming into the end of the year. So in that case, you would be looking at $3.35 per share. And if you apply an 8 times multiple on that EBITDA per share, that suggests the company might be worth closer to $26.83. So it would be more than a double from here. And looking at the seasonal rates, it's certainly possible. I'm not saying it's going to happen, but given all the factors that I mentioned, the 5-year average being at around or having shown in October the ability to really rise, when over the last 5 years, we haven't necessarily had the fleet being as tight as it is now. Who knows where it can get to? Interesting. And the big one, the management, especially when we're talking shipping. So the BW Group is a group that I have really been looking at recently and really understanding how they are, in fact, different to the operators in the space. You may know I also own BW Energy, and it's done very well, even though there's a little situation happening in Gabon at the moment, I understand. The BW Group, proven, they have a very large vested interest in this company. And so that's exactly what I want to see in terms of who's managing my investment. And this chart, I think, does a good job of showing that. So when you look at what they've done here, there's a bit of a graphical image of their cash flow statement for the last quarter. Here's what they had in cash. Here's what they earned via EBITDA. And then you subtract away what they spent: debt repayment, cash interest, dividends, share buybacks, which did a good job. Maintenance capex, note that as very, very small amount compared to what the company makes. This is a very, very good thing. Where are we? Okay, so new investment capex, they spent $9.5 million, but again, that's a tiny percentage of what the company makes. And given the state of the fleet, they're not going to put a dent in the fleet anytime soon that would affect day rates, change in working capital, other, so on and so forth. So I like how they do that. You can see what they make and where that money goes quite visually. Their capital allocation strategy: do management treat shareholders like shareholders? And the answer is they do. So in accordance with their policy to pay out 100% of their net income as quarterly cash dividend. Now, that is music to an income investor's ears. Their dividend of 35 cents was equal roughly to their quarterly earnings. Okay, so 100% of their net income. That's what the company is going to do until things start to change. And that is exactly what they should be doing. Share repurchases, and they also bought back 1 million of their own shares, okay, at a price of $8.25. So very good. Yeah, this is what happens when you have management that actually owns the business that they run. They tend to do a good job at running it. And so, yeah, not much more to say on that one. If we look at the charts, here's a big historic view. We had bull market, oil went up, and then we had the GFC, and it's been crawling along in the doldrums since then until we got this little breakout. So I don't know where this company can get to. This is chart crime to a degree because it doesn't take into account, this is just a price. It's not market cap or enterprise value. It doesn't take into account any dilution or anything like that. But it just gives a quick overview as to what could happen and what has happened in the sector. If you compare the HT to Frontline, bigger companies, slightly more diversified, they normally have tracked historically very, very closely. Frontline has broken out recently, and I just think that is because it's a better known company. They've done a merger with Euronav that I've spoken about before, and I would expect DHT to close that gap, absolutely. So I am long the company. I'm looking to build it up in the public portfolio to amount 3 to 5% of assets under management. In the private ones, it may even get a little higher than that, depending on what happens over the next month or so. It has speculative potential, but I think it's a decent short to medium term investment, given the fact that it's trading at a discount to its net asset value. And we know the order book is pretty much all wrapped up for at least another 2 to 3 years. Target price, take a guess. If you just look at the steel value, the replacement value, there's a lot of upside. In addition to which, the company has huge torque to the tanker rates. So that could be a little bit of a right tail factor there. My tactics and long-term portfolio, I'm just buying straight equity. If you check out the link below, you'll see the income strategies that I'm using to really juice the hell out of this and make some juicy 1 to 2% returns per week in the options market using this particular stock. So check that out. There's a free trial and all of that. I'll be entering in tranches. Thank you for watching. Please do like and subscribe. Follow me on Twitter. It's not the ROI channel anymore. It's at the Mav Life to support the new publication. And if you're interested in adding the portfolio to a watch list or investing in the portfolio, you can do so simply by downloading the eToro app, adding some funds, and pressing copy. It really is that easy. Otherwise, I wish you all the very best. Stay safe out there. Do your own due diligence, and I'll see you in another video shortly. Take care.